So, what's a company actually worth? I mean, it sounds simple, right? But here's the crazy thing. You could ask three different experts to put a price tag on the exact same business, and you'd probably get three completely different answers. So, what gives? Well, it turns out valuing a company is way more than just counting the cash in the bank. It's all about perspective.
So, how do you actually find that true price tag? How do you cut through all the noise? It really boils down to the question you're asking. Are you looking at what the company physically owns? Or maybe what similar companies are selling for? Or are you trying to predict what it's going to earn down the road? See, each one of those questions is a different lens, and each one will give you a totally different number.
Okay, so here's our game plan. We're going to tackle this by looking through three main lenses. First up, the balance sheet, what a company owns. Then we'll do some market comparison. What are similar companies worth? And finally, we'll get into the future forecast. What will it earn? It's going to be a journey from the tangible to the, well, not so tangible. Let's dive in. All right, let's kick things off with approach number one, the balance sheet. This is probably the most, straightforward way to think about it. The best analogy? It's like a corporate garage sale, seriously. Imagine you liquidate everything, sell off the buildings, the computers, the inventory, all of it. Then you take that pile of cash and pay off every single one of your debts. Whatever's left in your hand at the end, that's the value. This is what's officially called the asset-based approach, and it's exactly what it sounds like. It's a snapshot, right? A single moment in time, based purely on what's written in the accounting books. The formula is as simple as it gets. Total assets minus total liabilities. That's it. What you get is what we call the company's net asset value. Okay, so this is where it gets really interesting because there's a big trade-off. The upside? This method is super simple and tangible. It gives you a rock-solid floor value. You can say with confidence, the company is worth at least this much. But, and this is a huge but, its biggest flaw is that it's looking completely in the rearview mirror. It's all based on what things used to cost. It completely misses the most valuable stuff in a modern business. Things you can't touch, like a great brand, killer software, or just its sheer potential for future growth. All of that is invisible with this method. So, if looking at just the assets is a little too basic, what's next? Well, you'll look around at the neighbors. I love this analogy. It's just like buying a house. You wouldn't value a house just by adding up the cost of the lumber and bricks, right? No way. You check the listings for similar houses on the same street to see what they sold for. And guess what? In the world of business, it's pretty much the same idea. This approach is called relative valuation. And instead of looking inward at the company's own books, we're looking outward to the market. The whole game is to find comparable companies, its comps, and see what investors are actually paying for them. And we often do this using a handy shortcut called a multiple. A super common one is the PE ratio, price to earnings. All that means is, for every single dollar the company makes in profit, how many dollars are investors willing to pay for the stock? It's a quick and dirty way to gauge market sentiment. Now, the big advantage here is that this is grounded in reality. It's not theoretical. It's what people are actually paying for similar stuff right now. But, and you knew there was a but coming, it has a couple of massive pitfalls. First, finding a truly comparable company, a real one-to-one twin, yeah, that's nearly impossible. Every company is unique. And second, what if the entire market has lost its mind? Let's go back to that house analogy. If you're in a massive housing bubble and all the houses on your street are ridiculously overpriced, comparing your house to them doesn't tell you its true value. It just tells you that yours is overpriced too. Okay, this brings us to our third and honestly most sophisticated approach. So let's just forget for a second what the company owns, and let's forget what the neighbors are doing. Let's ask the million-dollar question, or maybe the billion-dollar question. How much cold, hard cash is this business going to generate for the rest of its existence? The best way to think about it is like valuing a money tree. You don't care about the cost of the seed. You care about the value of all the fruit it's going to produce forever. And this, my friends, is the legendary discounted cash flow method, or DCF for short. Now, it sounds complicated, but the core idea is actually super intuitive. It's this. A dollar in your hand today is worth more than a dollar you might get a year from now, right? So what we do is we try to predict all the cash a company's going to make in the future, and then we systematically discount it. We reduce its value to figure out what all that future money is worth in today's terms. That gives us its intrinsic value. So, how does this actually work? Well, if you break it down, it's a three-step process. Step one, you got to put on your fortune teller hat and forecast the company's cash flows out into the future. We're talking 5, 10, sometimes even 20 years. Step two, you have to pick something called a discount rate. Just think of this as an uncertainty penalty. The riskier the future seems, the higher the discount rate, and the more you penalize those future earnings. And finally, step three, you crunch the numbers and add it all up to see what that entire stream of future cash is worth today. And this quote right here from our source material just nails it. It really shows you the massive shift in how we think about business today. It says, loans will be executed based on the value of future cash flows, not collateral value. Think about that. We've moved from a world where value is all about collateral, the physical stuff you own, to a world where value is all about what you can generate. It's about your earning power. It's the very soul of the DCF approach. So on paper, DCF is the absolute gold standard. I mean, it's forward-looking, it focuses on cash, which is what really matters. But here's the catch, and it's a big one. The final number you get is incredibly sensitive to the assumptions you make. Your valuation is only as good as your forecast. If you change your guess for the growth rate by just a tiny little bit, poof, the final number can change by millions, even billions of dollars. So yeah, it's powerful, but it relies heavily on that crystal ball. So after all that, which method is the right one? The asset-based, the market comps, the DCF? Well, the truth is, none of them are perfect on their own. Any smart analyst will tell you the real secret is to not pick one. It's to use all three. Think of it like a detective at a crime scene. You don't rely on a single piece of evidence. You gather fingerprints, witness statements, and forensic data. You triangulate to find the truth. It's the same here. You use all three methods to build a complete, defensible case for what a company is really worth. And this chart right here just brings it all together beautifully. The biggest takeaway is this. Valuation isn't about finding one single magic number. It's about defining a reasonable range. So in this example, you can see the asset approach gives us a floor, say $80 million. The DCF, our crystal ball, points to something like $95 million. And the market, by looking at its peers, is screaming $110 million. The real, true value, it's almost certainly somewhere in that zone. All right, let's boil this all down to the key takeaways. Number one, and this is the big one, a company's value is a range, not a single price tag. Got it? Cool. Number two, just remember those three core questions. The asset approach asks, what does it own? The relative approach asks, what are its peers worth? And a DCF approach asks, what's it going to earn? If you can get a handle on all three, you've got the whole picture. Because at the end of the day, a smart valuation is part science, the hard numbers, and part art. That's the judgment you bring to the table.
So I'll leave you with this final thought to chew on. The next time you're looking at a stock, maybe one you own or when you're thinking about buying, just stop and ask yourself, what story is the market telling me with this price? Is this price tag all about the stuff the company owns? Is it just riding a wave of hype from its competitors? Or is there a genuine, deep-seated belief that this company is going to be a cash-generating machine for years to come? Because understanding how it's being valued, well, that's the key to figuring out what it's really worth.